Two people start investing on the same day, same amount of money, same goal, same optimism. 10 years later, one of them quietly outperforms the other. Not by luck, not by timing, by one decision they made at the very beginning: stocks, or ETFs. And here's the uncomfortable part: most people don't actually understand the difference. They think they do. They've heard the words, seen the TikToks, maybe even made money, but they're playing two completely different games without realizing it. So the real question isn't which makes more money. It's, what game are you actually playing? Right now, more people than ever are entering the market. Apps made it easy. Content made it exciting. And zero commission trading made it feel almost risk-free. You can buy a piece of a company in seconds, or you can buy a slice of the entire market. And that's where the fork in the road appears. Because stocks and ETFs don't just behave differently, they demand different personalities. Let's start simple. A stock is ownership in a single company. You pick one business and you bet on it. If it grows, you win. If it struggles, you feel it immediately. It's direct. It's focused. It's personal. You're not just investing, you're choosing. Now an ETF, an exchange-traded fund, is something else entirely. It's a collection. Instead of picking one company, you're buying dozens, sometimes hundreds, in one move. Think of it like this. Buying a stock is choosing a single player. Buying an ETF is buying the entire team. Sounds safer, right? It is. But safety has a cost. And this is where things get interesting. Let's talk about returns, because this is where most people get pulled in. You'll hear stories. Someone bought a stock, it doubled, tripled, 10x. Those stories spread fast. They feel exciting because they are, and they're real. But they're also incomplete, because for every stock that explodes upward, there are dozens that quietly underperform, stagnate, or disappear. You just don't hear about those. ETFs, on the other hand, don't explode. They don't go viral. They grow. Steadily. Almost boringly. And that's exactly why they work. Here's the uncomfortable math. If you invest in a broad market ETF, historically, you're looking at roughly 7-10% average annual returns over the long term. Not every year, but over time. Now compare that to picking stocks. Yes, you can beat that. But statistically, most people don't. Not because they're not smart, but because the game is harder than it looks. Think about what stock picking actually requires. You need to understand a company's business model, its competitors, its financials, its future risks. And then, you need to be right, not just once, but consistently. Because one bad decision can wipe out several good ones. And here's the part people don't like to admit. Even professionals struggle to do this long term. So when someone casually says, just pick good stocks, they're skipping over the hardest part of the entire process. ETFs remove that burden. They don't ask you to predict the future of one company. They assume something simpler, that over time economies grow, businesses evolve, and the winners replace the losers. So instead of guessing who wins, you own all of them. But this creates a different problem. You also own the losers. Always. No matter what. This is the trade-off most people don't think about. Stocks give you precision, but demand accuracy. ETFs give you diversification, but limit upside. You're either narrowing your focus or accepting average outcomes. And average sounds like a bad word until you realize what average actually means in markets. Because average, compounded over decades, becomes powerful. Quietly powerful, the kind of growth that doesn't look impressive in a year, but becomes undeniable over 10, 20, 30 years. Now let's talk about behavior. Because this is where most investing strategies fail. Not on paper, But in real life, stocks are emotional. They move sharply. They react to news, rumors, expectations. And when your money is tied to one company, every headline feels personal. You check more. You react faster. You second guess yourself. ETFs don't trigger that as much. They move slower, more stable, less dramatic, which means you're less likely to make impulsive decisions. And that might be the biggest hidden advantage of all, because investing isn't just about choosing the right asset, it's about surviving your own reactions. Now zoom out, because this decision, stocks versus ETFs, isn't just about returns, it's about time and attention and how involved you want to be. If you enjoy research, if you like analyzing companies, if you're willing to accept mistakes as part of the process, stocks might make sense. Not because they're better, but because they match the way you think. But if you want something simpler, more passive, something that doesn't require constant monitoring, ETFs start to look very different. Not exciting, but efficient. And here's the irony. Most people start with stocks, chasing higher returns. Then over time, they drift toward ETFs, not because ETFs changed, but because their perspective did. They realize that consistency often beats intensity. So what should you choose? That's the wrong question. The better question is, what kind of investor are you willing to be for the next 10 years? Because this isn't a short-term decision. It shapes how you interact with money, with risk, with uncertainty. You can try to beat the market, or you can become the market. Both paths work, but they require very different mindsets. And that brings us back to those two people at the beginning. Same start, same opportunity, different choices. Over time, one tries to outsmart the system. The other quietly lets the system work. So here's the real question. Not which one makes more money, but which one you'll actually stick with when things get unpredictable. Because in the end, the strategy that wins is the one you don't abandon. But here's where things take another turn. Because there's a third layer most people never even consider. Control. When you buy a stock, you're in control. You decide when to enter, when to exit, what to believe, and what to ignore. If you think a company is overvalued, you can walk away. If you see something others don't, you can act on it. There's a sense of ownership that goes beyond money. It feels like strategy. With ETFs, that control disappears. Decisions are made for you. Indexes rebalance. Companies are added, removed, replaced. And you don't get a say. You're outsourcing judgment in exchange for simplicity. And for some people, that trade feels uncomfortable because it means admitting something subtle but important, that you might not have an edge. This is where ego quietly enters the picture. Stock picking appeals to the idea that you can outperform, that you can see what others miss, that with enough effort you can beat the system. And sometimes you can, for a while. But the market has a way of humbling that belief, not immediately, but eventually. Because it's not just you trying to win, it's millions of other investors, analysts, institutions, algorithms, all competing, all searching, all adjusting. So the question becomes less about intelligence and more about probability. ETFs don't try to win that competition. They accept it exists and step around it. They don't chase the best company. They hold all of them. They don't predict the future. They participate in it. And that sounds passive, almost too simple. But simplicity is often misunderstood. Because simple doesn't mean easy. It means fewer decisions, and fewer chances to get those decisions wrong. Now let's introduce something most beginners underestimate. Time horizon. In the short term, stocks can look like the obvious winner, sharp moves, quick gains, clear stories. It feels like progress, like momentum. But zoom out far enough, and the picture changes. Because over long periods, the biggest advantage isn't picking the perfect asset, it's staying invested, continuously, without interruption. And this is where ETFs quietly dominate, not because they grow faster, but because they're easier to hold. There's less temptation to react, less noise, less stress, which means fewer mistakes. And mistakes in investing are rarely small. Selling too early, buying too late, chasing trends, panic, exiting during downturns. Each one chips away at returns. Not dramatically at first, but over time it adds up. So while stocks offer higher potential upside, they also increase the chances of behavioral errors, and behavior is where most portfolios break. Now here's something even more subtle. Opportunity cost. When you focus on individual stocks, your attention narrows. You follow earnings calls, news cycles, market sentiment. Your time gets consumed, and that time has value. ETFs, on the other hand, require almost none of that. They free up your attention, which means your energy can go somewhere else. Building income, improving skills, expanding opportunities. And this creates a strange paradox. The more passive your investing becomes, the more active your life can be elsewhere. So now the choice becomes clearer. Not easier, but clearer. Stocks are a bet on your ability to be right. ETFs are a bet on the system working over time. One demands involvement, the other rewards patience. And neither is perfect. Because even ETFs carry risk. Markets crash, economies slow down, entire decades can underperform expectations. There are no guarantees, only probabilities. Which brings us to the final layer, expectation. Most people enter investing with unrealistic ones. They expect fast growth, clean upward trends, predictable outcomes. And when reality doesn't match, they switch strategies. Again and again, stocks to ETFs, ETFs to crypto, crypto back to stocks, always searching, always adjusting, always slightly out of sync with the market. And that constant shifting is often more damaging than choosing the wrong asset in the first place. So maybe the real decision isn't between ETFs and stocks. Maybe it's between clarity and confusion. Because once you understand what each path actually demands, the answer becomes less about performance and more about alignment. Do you want to analyze, decide, and compete? Or do you want to participate, hold, and wait? Both paths can build wealth, but only one will feel sustainable to you. And that's the part no chart can show, no statistic can prove, no influencer can decide for you. Because in the end, the market doesn't just test your strategy, it tests your consistency, your patience, your ability to stay with a decision long after the excitement fades. So before you choose between ETFs and stocks, ask yourself something more uncomfortable. When the market drops, when headlines turn negative, when your portfolio doesn't move for months, will you trust your system, or will you start looking for a new one? Because that answer matters more than the asset you pick. And maybe that's the quiet truth most people miss. It was never really about ETFs or stocks. It was about you. Because the market doesn't reward activity. It rewards discipline. And discipline is hard to measure until time passes. Think about it. The investor who jumps between strategies, always reacting, always adjusting, feels productive, feels smart, feels in control. But over time, that constant movement creates friction, small losses, missed recoveries, broken compounding, nothing dramatic, just erosion. Now compare that to someone doing less, holding steady, ignoring noise, letting time do the heavy lifting. From the outside, it looks passive, almost lazy, but underneath, something very different is happening. Compounding, slow at first, then undeniable. And this is where the story quietly flips. Because the investor who looked inactive ends up ahead, not because they knew more, but because they interfered less. So when people ask, which is better, they're usually asking the wrong thing. They're looking for an answer that removes uncertainty, a shortcut, a guarantee, but there isn't one. There never was. There's only a trade-off, always. With stocks, you trade simplicity for potential. With ETFs, you trade potential for consistency. And whichever path you choose, you inherit its consequences, more decisions or fewer, more control or less, more volatility or more stability. None of these are free. So maybe the real edge isn't in picking the perfect investment. Maybe it's in removing the need to constantly rethink your decision. Because the moment you stop questioning your strategy every time the market moves, you gain something rare. Focus, and with that focus comes time. Time to let your investments grow. Time to build income outside the market. Time to think long-term without being pulled into short-term noise. And that's when investing stops feeling like a game and starts becoming a system you trust, a system you follow, a system you don't abandon the moment things get uncomfortable. Because they will get uncomfortable. That part is guaranteed. Markets will drop. Stories will change. New opportunities will appear and tempt you. And in those moments, the difference between ETFs and stocks won't matter nearly as much as your ability to stay consistent. So if you're still looking for a final answer, here it is. Choose the path that makes it easiest for you. To do nothing, not because doing nothing is easy, but because in investing, doing nothing is often the hardest thing of all. And the people who master that don't just grow their portfolios, they outlast the noise. And in this game, outlasting is everything.